Hello guys and welcome back to a stock analysis slash deep dive into waste management. Now we have had a little bit of a choppy ride with a nice little roller coaster effect of going up and down, with many stocks being volatile with the news and other bits and bobs going on in the world. And of course the stock market hates it when it's very uncertain. But there's one company that hasn't really got a lot of attention yet continues to perform very well in these type of situations. And as you can gather, that is right, it is waste management. So today we're going to take a closer look at what the waste management stock is, talk about whether it could be considered to be a good buy right now, and we are going to go through the company's performances, earning result, fundamentals, and valuation to see really how strong this business really is. Now, we are going to start by looking at the waste management chart. Now, year to date is actually up 8.75% at the time of recording, and it's been 1 year, 8%, 5 years, nearly 100%, 10 years, 312%. So little steady growth. Not major, but it's still steady. Now, even when the overall market has been mixed, the stock has continued to trend higher, especially over the long term. Now, Waste Management is a holding company which engages in the provision of waste management, environmental services. It operates through following segments, including the collection and disposal west tier, and recycling, processing, sales, renewable energy, and healthcare solutions. Now, they do put them in tiers of their collection and disposal, so we will have a look at that in a mo. Now, they are based in the United States. They are industrial or environmental services. They have a market cap of roughly 96.21 billion. Now, they IPO'd in 1988 with roughly 60,000 employees at the company right now, with a dividend growth streak of 22 years, with a 5-year dividend growth at 11%, and the dividend yield is at 1.58%. Now, the founder or CEO or slash CEO is James C. Fish. So, the revenue. So this is the revenue chart. As you can see, the last annual revenue report was $25.2 billion. That's a 9% growth in 3 years, 11% in 5 years, and a 7% in the 10 years. Now, one of the biggest reasons the stock has performed very well is because the revenue has continued to grow very well, as we can see. Now, after around 2020, you can see the company's sales started to increase very fast, which helped drive earnings higher. Most of the waste management revenue comes from collection and disposal, which is the largest and most stable part of the business. This is why they also make money from recycling and healthcare services and renewable energy products, so they can also diverse. So they're not actually having to rely on one revenue segment. Because these services are always needed, the company has very predictable income, which makes most of the business more stable than many other companies. Because many of you guys, like including myself, we do chuck out a lot of waste. We do try and recycle as much, but especially when you have people coming over, especially for big events. I know you guys in the United States have Thanksgiving dinners. That stuff piles up, and you need a service that gets rid of it. And of course, that's what waste management does. Now let's go on to the fun part, which is dividends, because a lot of us get dopamine effects when we see on our phone or on the computer or even in our emails that we have been paid a dividend. Well, thank goodness that Waste Management pays a dividend, and that's why it's on my radar. Because this company has a long history of paying dividends and increasing them over time. Now, I am quite unsure why alpha spread, which I've used for the graph, the chart I mean, it says 0 dividend streak. Well, that ain't right. It has been growing, and as we can see in the last 5 years, it's grown by 12%. Now, the company has been trying to keep the dividend at a safe level by paying around 40 to 50% of free cash flow. That means the dividend can keep growing as the company makes more money without putting too much pressure on the business, because if we go for a higher payout, that means less money is going back into the business because it's all being spent on trying to keep us shareholders very happy for getting the dividends. Now, for investors like myself, this is a very good sign because it shows the company is financially strong and it has a good boundary because it knows its limit and it hasn't really gone over the 40 to 50% mark of free cash flow. So that is very good, and it means that they're willing to be confident about future earnings. PE ratio, as we can see, that the PE ratio tells us exactly how expensive a stock can be compared to its earnings. But there's a lot of red. Now, don't be warned. I've been warned already that waste management always sells as a premium, but it would do because it's got very predictable earnings. You pretty much know what you're going to do, and especially with the growth of the earnings, of course, it will trade as a premium. And I think, to be fair, there's not many stocks, apart from technology stocks, that will trade at this high premium and get a predictable return. So, in many cases, the stock does trade in the low 30 range. Of course, once again, this means it's a premium pay. And right now, the PE ratio does suggest it's very much above its historic average. So it could suggest that the stock is a little bit expensive right now. But companies with steady growth and predictable cash flow often trade at these higher valuations because we, as investors, see them very safe. Now, as you can see, it is at its 35.5 PE ratio. Its average of the 3 years 32, the 5 years at 32.7, and the industrial average is 31, and the country average is 22.9. So as you can see, there is a few little bits of scale, but it's mainly between 9 to minus 36% of downside for its PE ratio, which isn't good. Just like we say, it means a little bit more expensive than what it should be. But a stock like this, I wouldn't mind paying a little bit of a premium. So let's go on to the 2025 earnings. So looking at the most earnings report, the company had a strong result overall. So the cash flow from operations grew by more than 12%, which is very much healthy growth, especially for cash flow indeed. The earnings did come in slightly below expectations, but the difference was very small. The company still showed solid performance. They also expect the earnings and cash flow to continue growing in the next year, which is a positive sign. So we need strong growth, which, like I say, that's a good outlook for the next year. And like I say, with a free cash flow growing from operations, growing more than 12% in 2025, that is really good indeed. So we have covered this very briefly, but we're just going to do a little snapshot of waste management. So it's a very large company with operations across North America. It has thousands of employees, like we gathered, and many facilities and a huge network of collections and disposal locations. Now, the 2024 revenue by segment, as you can see, 89% of that came from collection and disposal. Recycling came from roughly 7%, healthcare solutions 2%, and renewable energy was at 2%. Now, of course, as you can see, they have 105 recycling facilities. They have nearly 500 hauling operations, 262 solid active waste landfills. They have about 500 waste transfer facilities for medical and for stuff, 69 autoclaves, 18 medical waste incinerators. So, as you can see, there's a lot of diversification, which is very nice indeed. So, this doesn't really change. So, especially if you can go to 2023, 2022, or even the latest one, the collection and disposal is mostly the revenue that they get. Now, as you can see, they also in the UK and Ireland in many locations as well. So they are very much diversified in both the Americas and, of course, in Europe as well, especially in the UK and Ireland. So they do have a clear track record, especially for their growth. Now, this is really good because they set out really clear financial goals for their growth. And as revenue and cash flows, we want to see them growing. And as investors, we want to see them growing at a good, healthy rate. Now, in 2029 to 2021, their targets for the revenue growth was 4 to 6%. Now, they did have only a 3% growth, but that was affected by COVID. Now, they do want a 5 to 7% financial target in the operation EBITDA. I said that so wrong. But they actually got 7%, which is the high end of their target. Now, this is what makes me laugh, and especially when they had to deal with COVID in 2020, they had to have a 5 to 7% financial target for free cash flow, which is very good indeed, especially if it grows at least 7%. But they actually got 14%, which is very good. And then in 2022 to 2024, they got 6% in the revenue growth, 9% and 13% for free cash flow, which is good. It's growing in double digits, especially free cash flow, which we love to see indeed. Because especially with free cash flow, that can do many things like share buybacks, dividends, reinvesting into the company. Like there's so many things that you can do with that cash. And if it's growing in double digits, it just makes this company very more strong and very better, especially in times where the market does struggle and goes down and unsure with what's happening in the world. Now, as you can also see, they have a proven track record for shareholder value. Over the long term, Waste Management has given strong returns to the shareholders. The stock has been going up steadily and has been less volatile than the actual market, which is very good. This means investors have been able to get good returns without taking much of a risk, because as you can see, from January 2015 to May 2025, Waste Management actually gave you 476% return of your shareholder value, where if you actually went on the Industrial Select Index, you'd only got 205%, and the DGIA, you only had 137%, which, you know what, Waste Management beating that by definitely over double of the index. That is really good. Now, of course, you need to remember the returns remain through COVID-19, labour shortages, wage inflation, political administration changes, and a lot more in that they've had to deal with, which is, once again, very good for a stock that is trading at very much a premium. Now let's go through some earning details. As we can see, so in the earning reports, the company did say we delivered a record performance in operation expenses as a percentage of revenue for both the fourth quarter and the full year, resulted in the best full year adjusted operation EBITDA margin. Now, of course, in 2026, they think they're going to continue the momentum and they expect to grow free cash flow by nearly 30% at the midpoint of their guidance. Now, that's really good because they plan to harvest the benefits of their investments and return to shareholders approximately 3.5 billion in 2026 through dividends and share repurchases, while also returning our leverage ratio to our long-term target between the 2.5 to the 3x, which is really good. So that basically means the company is trying to keep their costs low while the revenue is growing and their profit margins increase. Now, of course, this is really good because their capital allocation needs to be a lot better. And it is. It is. Now, of course, they did mention in the last bit they are trying to return their leverage ratio to the long-term target of 2.5 to 3x. Now, we will get to that point in a little bit. But with their capital allocation, they have at the moment a 3-year history of 7.4% compounded annual dividend growth rate. They're going forward at 40 to 50% payout ratio, which they want to see. Now, of course, they do have a strong balance sheet and a good credit rating. The debt has increased after a recent acquisition, but the company plans to bring it back down to its normal range. Keeping debt under control is important because it makes the company safer during the economic downturns and gives more flexibility, which, is very much good because this helps because good capital allocation as well helps the company grow while also rewarding investors. And Waste Management, once again, has a history of being disciplined with this. Now, we did mention, like we say, the target leverage ratio. As we can see in this one, we had a 2.5 to 3x ratio. Now, we can see that it's been quite steady. From, if you exclude 2020 and 2024, they were pretty much in target range with between 2.71 to 2.75. Now, they have gone up a little bit over the ratio target because they got Sterile Circle and Advanced Disposal acquisitions. Now, of course, that does bring the debt up. So, of course, the weighted debt goes up and the target leverage ratio doesn't actually stay where they want to. But in 2026, hopefully, they are going to bring that back down and it will be below the 3x target, which will be very good. Now, as we have mentioned, they have got very good, strong credit ratings from Moody's, S&P, and Fitch. So, and they have their debt coming down as well, which is once again very good indeed. Now, as we've already mentioned, dividends, their dividends per share and buybacks. Waste Management has steadily increased their dividends per share over time. At the minute, they're roughly $3.30 per share. Now, they also have brought back shares, but in 2019 to 2020 and 2024, when they got the acquisitions, they did stop that buyback cycle. But they do buy a lot of shares, and they have pretty much doubled reduced their share outstanding by 12.7% since 2014. Now, they are wanting to do that again because they have brought their debt leverage down. So, of course, that means they can also buy back shares very well indeed. But like I say, both dividends and buybacks are very much a good way for the company to return money to the shareholders. Now, we did mention about the free cash flow, and oh my god, it has risen to its highest point in 2026. If you exclude that, it was the only time that it was the highest was actually in roughly 2022 to 2021. So once again, we see cash flow once again growing to an extraordinary amount when the market is actually going down. And you don't really see that in companies and stocks like this, especially in a market downturn. But we have done very much well for waste management with just over 260 million pounds, I believe that is. So you look, that's good. Yeah, so 280 million pounds has gone up. That is really good, especially when the stock price is at 238. The free cash flow has been trading higher, and as you can see, the stock price has been going up, and so has the free cash flow. The free cash flow has followed the stock price going up, which is really good because, like I say, free cash flow can give you dividends, share buybacks, and a lot more, like reinvesting into the company. So, as you say, that is waste management, and I hope you guys did enjoy looking at a very strong and stable company, which has its growing revenues, reliable dividends, strong cash flow, and a business model that is very predictable. Now, the stock can sometimes trade at a high price, but like I say, investors like myself are willing to pay more because the company is consistent and low risk. Now, because of this, I think waste management can be seen as a high quality long term stock, but it's also important to pay attention to its valuation before buying. And some people, I like, especially myself, are just going to wait for a little bit for the price to come a little bit back down to add a little bit more to the stock. However, if you are going to dollar cost average into it, I wouldn't mind starting today. But like I say, once again, I'm not a financial expert, and please do your own research. And like I say, I hope you guys enjoyed. Hit the subscribe button if you did. Leave a like, comment down below any other stocks you want me to check out, and I'll see you on the next one. Goodbye.